Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, December 7th, 2024. Hey, how you doing? Greetings from Santa Marta, Colombia. I've been down here for a few weeks, and I made a little video. Well, they shot a little video last night when we were playing baseball on the beach, but man, just a perfect environment. Baseball, which I love, and um, beautiful, beautiful sea and the beach, and I had some friends and the dog. Look, I'll just run the quick little video for you.
Ah, no, ya no vamos a jugar. Ella no va a jugar. Ella no juega. Ella no juega. Ella no juega. Ella no va a jugar. Todas las seis.
Pretty nice, right? Pretty nice. Baseball, beach, good friends. Anyway, it was just kind of a nice moment and wanted to share it with you. So I hope you're doing well. I appreciate you coming to my weekend review podcast. The format for the podcast today is first, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week and the positions that I'm still in and the positions that I got out of. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the signals were, and then how I am going to manage the trade going forward. We're also going to talk about how I position sized when I got into the trade, where I placed my emergency stop, where I placed my end of day stop, how I'm going to take partial profits if the trade starts moving my way. Also, when it does move a certain amount for my entry, then I go into trailing stop mode. I'll talk about that. And then when it gets to serious overhead resistance levels, I'll look at how I exit the trade fully. So I hope that's going to be helpful for you, give you an idea of how I view trading and how I manage the trades going forward. After that, I am going to do we'll do a few minutes on trader psychology. Trader psychology is the most important skill in trading, the ability to wait, be patient, take your trade, and then follow the plan of the trade that you took. You know, we can have a great trading plan and get into the trade, but if we don't follow the plan, what good's a good plan? There's all sorts of good plans out there. You don't have to trade the way I trade. There's many different ways to trade and many different good ways to trade. But the key is you have to follow your plan. You have to set up your plan your trade your plan. So, and that all comes down to psychology. So we'll talk a little bit about that. Hope that's going to be helpful for you. And I hope it's all going to be helpful for you. And if it is, I would appreciate if you could hit the thumbs up button. It really does help the channel, helps YouTube know that there's some valuable content. So if you could do that, I would appreciate it very much. Thank you so much. After that, I have gone down through my watch list every Friday night. I do go down through my master watch list, both on the daily time frames and the weekly time frames. And I've identified some potential trades for next week. These markets are not where they need to be, but I have identified some levels that if they get to those levels, those confluences, those combinations of levels, then it would make sense for me to potentially take the trade. All right, so hopefully that will be helpful for you as well. And I think I've got 10 on the daily, 2 on the weekly, and I'll go into depth more of uh, what I'm waiting for, where I'm waiting for the markets to go to potentially take the trade. So anyway, let's get started. Let's run that U.S. legal disclaimer in about 40 seconds. Apologize about that, but after that, we'll get rolling. So hang tight. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, let's get rolling. First on deck is TLT, which are the 20-year bonds. On this first trade, I'll go through it a little bit slower. All the details of my stops and position sizing, trailing stop level, all that. And then as we move forward to other trades, I'll go a little bit quicker. All right, so let's take a look at why I took the trade. I got long TLT back here on the 15th of November at $90 even. So the question is, why did I buy there? Well, a couple reasons. Uh, Usually I like to look for a confluence of things happening at the same time. And there were. But I want to bring your attention first to this green box here. What is this green box? Because that had everything to do with why I took the trade. Well, if you look all the way back here on the 29th of May, you see this big down bar. This is called the bullish order block. It's called the bullish order block because it's the biggest down bar before we change market structure to the upside. And we change market structure to the upside by taking out this swing high here about 92.18. So broke structure to the upside and fooled around here. Then we had this big run up. But the reason it's important is order blocks, again, the lowest low close before market structure change. This has a memory. And if you ever come back down to that original order block, not every time, but more chances than not, it will bounce there again. And that's exactly what happened. So you can see I drew this order block all the way out here and extended it out. The other thing that was going on is that we had a double bottom bullish divergence. And what's that? Bullish MACD divergence. Well, you can see this huge sell-off in bonds, massive sell-off in bonds. And you can look at the corresponding MACD bars, these red bars. You can see that we came very, very low, low, low. These MACD readings, the MACD was very deep, meaning the momentum was very strong to the downside. And then we bounced and we turned green here on the MACD, but then we came back and retested that low. And you can see that this low here is obviously lower than these lows here, but there were no red MACD bars. So if you're lower here and you don't have any red bars, what this means is it's running out of momentum. And if you run out of momentum, you're running out of sellers in this case. And if you run out of sellers, the implication is that you are going to go higher. And that's exactly what happened. So the reason I took the trade was on this particular day at $90 was because we basically 1, 2 days, and then the next day again, 3 days, we bounced and kind of tested that order block. The market didn't want to go lower than that. So that in combination with this double bottom bullish MACD divergence, that is the reason that I took the trade. So again, I took the trade at $90. So the first thing when you take the trade, it's very important in my opinion that you position size correctly based upon two things, based upon your trading account value and also the volatility of the market. So your trading account value, you already know what that is. But how I measure volatility is with the 2 ATR. You can see right here, right now, the 2 ATR is 227, and all that means is it's 2 times the average range. 1 time the average range is what it is expected to move based upon the current market volatility. 2 times is outside of that range. It's outside of noise. It should not go down there. If it does, something's really wrong. So what I do is I take 1% of my trading account. Let's say it's $100,000. 1% of your trading account of $100,000 is $1,000. So I take $1,000 and then I divide it by the value of the 2 ATR. So in this case, it's $2.27. So based upon, $1,000 divided by 227. So the way that I trade, based upon the current market volatility of the market and the account value, which is $100,000, 1% of that, 1,000 divided by the value of the 2 ATR. For me, the correct amount of shares to buy based upon this information is 440.5. So I would just round that up to 441. If you had $1 million, 1% of that is 10,000. You take the 10,000, divide it by the 227, you get your number. If you have a $25,000 trading account, 1%, that's 250. It doesn't matter. It's just the same formula. But then, based upon the current market volatility and your account value, it's a pretty good rule for me, and that's how I position size. So once I entered the trade, again, I entered at $90. Now I bought 441 shares. The first thing I do is I place my emergency stop 2 ATRs below. How much is that? It's the value of the 2 ATR, 227. So I take my entry minus the 227. Now that is my emergency stop. So if I have 441 shares, if it moves down to my emergency stop, $2.27, how much have I lost? $1,000, right? Because we just divided it into it. So that is my emergency stop. Now, if after I enter, if it ever hits my emergency stop, ever, at any part during the day, I immediately get out, because now I have lost the maximum allowed that I want to lose on a particular trade. But the good news, this only happens 5% of the time. The other 95% of the time, if you have a losing trade, it will be because your end of bar stop. And 95% of the time, your end of bar stop will get you out of the trade. And that's based upon the closing price. And what is my end of bar stop? It's a close below this value zone all the way back here, this bullish order block, all the way back here on the 29th. So that is 88.68. So I have my two stops. I have my emergency stop. I did the math. If it gets there, I lose $1,000. My other stop, my end of bar stop, if it closes below 88.68, I would get out there on a closing basis, but I would lose less than the 1%. All right, so those are the two stops. The next thing I do is I look at the value of the 1.5 ATR. Right now it's $1.70. And so I take my entry price and I go up $1.70 for my entry price. What is this? This is my trailing stop level. So if it ever moves to that level, now I go into what is called trailing stop mode. And all that means is now in the future, if I have a close below a previous bar's low after reaching trailing stop level, I will exit half of the position as a precautionary measure that I don't give it all back if it all comes back. Okay, now everything I've talked about so far, the position sizing correctly based upon your account value and your the market volatility. Your emergency stop, 2 ATRs below your entry, your end of bar stop, your trailing stop level. These are all defensive moves. In other words, if something goes against me, I take action. I take a certain action. But I also like to play offense in my trading, and the way I play offense is I take partial profits if the trade starts to go my way. So the other things were defensive if it goes against me, but I also want to take a portion of my position off if it moves up a certain amount. And so what is that amount? It changes every day. And essentially what I do here, I'll just do it for you right now. I take the closing price of the day. Right now it is $94.39. So I take the closing price, $94.39, and then I also have a 0.45 ATR value. And right now the 0.45 ATR value is 51 cents. So I take the closing price, $94.39, I add the value of the 0.45, which is 0.51 plus 0.51. My first profit target on Monday is $94.90. That's my first profit target on Monday, $94.90. Then I take my first profit target, $94.90, and I add the 0.45 to it again, which is now 51 cents. My second profit target for Monday is $95.41. Then I take my second profit target, $95.41. I add the 0.45 to it again. And so my third profit target for Monday is $95.92. So essentially what I do is I put 3 limit orders in. These are not the exact prices, but I put three limit orders in. It'll probably look something like this for Monday. And so I'll have 3 standing limit orders in, and at 10% of the remaining shares that I have. So if I went into Monday with 100 shares, for example, I would put a limit order in for 10 at the 10 shares of the first profit target, 10 for the next profit target, 10 for the next profit target. And, rarely do you hit 3 profit targets, but it's certainly possible. But very often you'll hit 1, you'll hit 2, and then that will reduce your position size by that amount. And now you have a smaller position size, and then the next day you take 10% of that. And of course, if it goes against you, well, you don't hit any profit targets. All right. So that is how I play offense, and I'm a big fan of taking partial profits when the market gives me a certain amount of profit, and the 0.45 makes sense for me. But again, it's not everything. It's just 10% of the remaining shares. So again, so that's the offense and defensive part. So let's just take a look at the trade again. Double bottom bullish MACD divergence, okay? Order block from back on May 5th. So when it came down, I saw the double bottom bullish divergence. I saw the bounce here and here at the order block. I took the trade, $90. I position sized correctly based upon what I showed you earlier. I placed my emergency stop 2 ATRs below. I placed my end of bar stop at 88.68, which was the low of the order block way back in May. I placed my trailing stop level 1.5 ATRs above, and we're ready to go. So the next day opens down, reverses up, did not go up enough for me to hit a profit target, so no action was taken. The next day it moved up. I did hit 1 profit target. Then we kind of came down here and consolidated for 3 days. No profit targets, no nothing. Then we had this big jump up. In this case, I hit 3 profit targets. And we also got to trailing stop level, which is important because now that we're at trailing stop level, if I have a close below a previous bar's low, I'm going to get out of half. But this particular day here opened, went under, but closed back above, kept me in the trade. Next day, up, hit another profit target. Next day, up, hit another profit target. Then a couple sideways here. This bar almost closed below this low, did not, so I did not sell half. Then we opened up lower, reversed back up, hit another profit target, and then we moved up and up. So right now we're at a 60-45 RSI level. If it continues up and I get to a 65 RSI level, now this 5 EMA will come into play as my stop. And if it gets to 65 RSI and then closes below the 5 EMA, then I am completely out of the trade. If it keeps going up, then I will continue to take partial profits, as we discussed. And then the next level that I'll be looking at is the 70 RSI. And if we reject this, if we get to the 70 and reject the 70 RSI, then I'm going to take half of whatever I have remaining off. And then after that, if I then get a close below a previous bar's low after rejecting the 70 RSI, then I am completely out of the trade. So I have a lot of rules. I've been trading for over 29 years. I have a lot of rules. Every rule I have, there's a reason for it. And this may sound complicated, but it's really not. And if you would like to learn exactly how I trade and all these rules, I do offer a one-on-one course in the evening time via Skype. It's a 15-hour course. Each session is 3 hours, and we have 5 sessions, and I teach you all the rules, everything with all the 7 different trading approaches that I use. I love to teach. I've taught people from all over the world, from absolute beginners all the way up to the hedge fund level. So, if you're interested in learning the techniques that I use, please send me an email. The email is in the link in the description. We can have a talk, and I'd like to learn more about you. You can ask me questions about the course, but it's a great course, and if you have any interest, please email me, and love to talk to you. So this particular trade, TLT, currently the remaining shares that I have, it's been a nice trade, up 4.66%. So that's TLT. All right, next trade, WBA, which is Walgreens. Okay. Well, this again is an order block trade, a bullish order block trade. And the order block is way back here on the 25th of September. Here's your lowest bar close. Then you have a structure change to the upside. And then a couple weeks ago, we came back down to that bullish order block, and I got long here at $8.31 because one, we came into the order block and rejected and went above, and then two, we had what is called a V1. V1 consists of two bars, bar one, bar two, and bar two goes below bar one's low, closes above bar one's close, and I got long here at 8.31. Okay, so if you want to learn more about V1s, V2s, go to my YouTube channel in the lessons playlist, and I have a video there. I use V1s, V2s so often. They're really the bread and butter of my trading. They're really good entry tools. So go check it out in my YouTube channel in the playlist, and I think you'll find it really helpful. So again, we have the order block back here on the 25th of September. We come back to it. We go in. It rejects. It closes back above. That's a key component. Plus, we had the V1. I got long here. $8.31. I position size correctly as always. I place my emergency stop 2 ATRs below, and then my end of bar stop is the low of the order block. A close below 798 is my stop. I place my 1.5 ATR trailing stop level above my entry. The next day shoots right on up. I think I hit 2 profit targets that day. I'm not sure, but I think I hit 2. And then the next day, again, another surge up, giving me another 2 profit targets. And I'm also in trailing stop mode. The next day does not close below the previous low, keeps me in. The next day we go up again. I hit another profit target. Then a few days of just kind of sideways motion, and then here on the 4th of December we have a close below a previous bar's low. After reaching trailing stop level, I exited half of the position for a gain of 4.81%. And then the next day we had a big sell-off. Glad that I took the half when I did. And then Friday it was up slightly, and the remaining shares that I have on this trade up 2.29%. And I wouldn't be surprised at all if we come back down, bounce again at that order block. Okay, so that's Walgreens. AGQ. AGQ, not an order block. This is a deep dip buy. Deep dip buy is really a good strategy that I use. I've used it for years. I also, at udemy.com, I have a video course. It's 9.5 hours on this one strategy alone. It's very affordable. The link's in the description of this video if you'd like to take a look at that and learn how to trade this particular strategy. And boy, I've had some big trades with this. But with deep dip buys, it incorporates 3 moving averages and the RSI. We have the 200-day moving average here. We have the 250-day moving average here. We have the 300-day moving average here. These are key long-term moving averages where large financial institutions and savvy traders come in at these levels. Also incorporates the 30 RSI, but we're nowhere near that right now. So I did buy here on the 27th of November at $37 even on the day where it came down, touched the 200-day moving average, but held above. So I entered at $37. I positioned size correctly. I placed my 2 ATR stop below. As always, my end of bar stop is simply a close below this 200-day moving average. If the next day it had just closed even a penny below, I would have just been out of the trade for a very, very small loss. So risk to reward, the closer you can get to your line in the sand, in this case, the line in the sand is 200-day moving average. If you're wrong, you can be wrong the smallest, because if it loses this 200-day moving average, that's a key level. And if it loses here, it may continue lower. So I got long here, $37. Next day gaps up nicely right off the 200. I think I hit 2 profit targets on this day. Next day we moved sideways. Then we moved up here on the 3rd, hit some more profit targets. Next day moved up again, hit some more profit targets, and I also got to trailing stop level. And again, all that means is now if I have a close below previous bar's low, I'm going to get out of half it. And that happened on Friday. You can see on Thursday, the low was 39.11, and we closed at 39.10, 1 penny below. If it had closed at 39.11, I would have stayed in the trade. But because it did close below the low, that was my signal to sell half of the position. And this one doing pretty well, up about 5.3%. So anyway, so far, pretty good trades. And then Caterpillar, I took a trade on Caterpillar on the 2nd of December. I got short here at $402.30. Why? Okay, let's look over here at these 2 bars. I have highlighted them in red. What made me highlight these in red? Well, we had what's called a bearish island reversal, because the previous day we gapped up very strongly, very good news, very strong. Then we had 1 day sideways motion, and the next day we, boom, gap down. So we had gap up followed by gap down. And when this happens and you look off into the future, generally you are lower. So I did not get short here. I wanted to see if the price after the island reversal happened, if it were to come back up and reject the bottom of this island reversal. And then here it came, but it didn't reject. Here it rejected. I didn't take the trade. And then we had a sideways bar, and then we rejected the trade. And I took this trade because, one, we rejected the bottom of this island reversal, and also we had an inside bar. When you have an inside bar and you go lower, you tend to go lower. So that in conjunction of the island reversal. So I did get short here, 402.30. Now, when I use an island reversal or an abandoned baby, I don't take partial profits. I do it differently than the rest of my strategy. It's actually quite simple. What I do is I place a 2 ATR stop above and a 4 ATR profit target below. So I just put it on, let the trade go. One of 2 things is going to happen. I'm either going to lose 2 ATRs or 1%, or I'm going to make 2%. And this strategy, in my experience, has a win rate of about 70%. So I'm confident that about 70% of the time I'm going to hit a 4 ATR profit target, and 30% of the time I'm going to hit a 2 ATR stop. And so far it has worked well so far, being short, and the current profit on this particular position up 1.83% so far. Okay, so just recap of the open positions. TLT up 4.66%. WBA, the remaining shares that I have up 2.29%. AGQ, the half position at plus 0.37%, and Caterpillar, the short, up 1.83%. Okay. So those are the open positions. Let's go to the closed out positions that I have, that I closed out last week. And here's Etsy. Had a really good trade on Etsy, and you can see here's the green order block down here. And again, it was your lowest low close here on the 29th of October. Then we changed market structure to the upside, and then we came back and we tested the order block, bounced off it. I got long here, $50.36. I placed my emergency stop 2 ATRs below, and my end of bar stops, the low of the order block, at 47.41. I placed my 1.5 ATR trailing stop level above. Next day moved up a little bit. I believe I hit 1 profit target. Then we moved up for 2 days in a row, but not enough for me to take a profit target. And then here on the 25th, big up move where I hit 2 or 3, I can't remember. And then we moved, and then we also got to trailing stop level, and then we just moved sideways here, no profit targets. And then here on the 3rd, another big up bar move, more profit targets. Next day, up again, more profit targets. And then here on the 5th, I exited the entire trade. Why? Well, because on the 4th, we closed above a 70 RSI. And remember when I said earlier that if we reject the 70 RSI, I'm going to get out of half? Well, that happened the next day. It did reject. It went above 70 and closed below the 70. So normally I would have gotten out of half, but I got out of the full position because not only did we reject the 70 RSI, but we also closed below the previous bar's low. So that was a nice, really easy trade based upon the bullish order block, and I closed out this position for a gain of 11.92%. Okay, Tesla. All right, so far they've all been positive, but Tesla just too strong. I got the signal, it was a legit signal, but this one just didn't work. Here we have an abandoned baby. We gap up, followed by immediate gap down. Then I waited for it to get to the bottom of the abandoned baby at 336. In this case, because it's an abandoned baby, I put a 2 ATR stop above, 4 ATR profit target below. It started off pretty good. Tesla just too strong. Here we had some hope again, but on Thursday, it did get to my 2 ATR stop, and I had to take the loss on this particular trade. Never fun, but you got to do it for a loss of 9.11%. So that was kind of a bummer, but the good news in here is that I did get out on Thursday and avoided this next move up. You know, when you have to take a stop loss, it's never fun, but if the next day, if it keeps going, you're out, but it keeps going in the direction you didn't want it to go, it makes you feel a lot better that you took the stop, obviously. So this one was a bummer, but did I lose 9.11% of my account? No. I lost 1%, right? Because I position sized correctly. So this one was a tough trade, but that's okay. And then Johnson & Johnson on the daily. I did get into Johnson & Johnson here on the 22nd of November. Deep dip buy. We had a close under 200, over 200. I didn't take it here. I waited for the next day where I had a little better risk to reward ratio. I got long 153.96. Position size, my emergency stop, 2 ATRs below. My end of bar stop closed below the 200-day moving average. Next day it moved up a little bit. Did hit a profit target, which was important in hindsight because then it did close below the 200. And then we moved down. We had another move up. So at least I did take off 2 profit targets before it reversed on me. So it mitigated the loss, which is important. And these things add up. And then here on the 3rd of December, it closed below the 200-day moving average. Didn't hit my emergency stop, but it did close below the 200-day moving average. And I had to take a loss here for 1.04%. So they don't always work, but the key is have yourself a process. So if they do work, you can have a big gain. And if they don't work, try to limit it. And you do that by position sizing and have a good risk to reward ratio. So on the closed out positions, Etsy up 11.92%, Tesla down 9.11%, and Johnson & Johnson down 1.04%. So those are all the daily positions. Let's do the one weekly position that I have, and this was on Adobe, and I took this back on the 8th of November. Deep dip buy. Close under the previous week, close over, and we also had a V2. Bar 1, bar 2, bar 3, bar 2 goes below bar 1's low, bar 3 closes above bar 1's close. I got long here, 494.68. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop, end of week stop is simply a close below the 200-day moving average. That never happened. Next week just skyrocketed up, thankfully. took some profits there while I had them, also got to trailing stop level. Then we moved right back down, but this week up again very strongly and obviously hit some more profit targets. There is earnings are coming out on the 11th of December, and so I don't hold through earnings. So before earnings, let's see, when is earnings on the daily? It's on the 11th. So I will exit before earnings. But this has been a great trade, a great deep dip buy trade here, and this one currently up 10.57%. So those are the positions. Not all positive. Rarely are they positive. That Tesla one was a bummer, but again, that's a 9.11% loss, but it's not, right? Because of that's the key. I mean, you can have a 20% gain, but that doesn't mean you're going to make 20% of your account. Or you can have a 20% loss, and that doesn't mean you've lost 20% of your account. If you, worst case scenario, most of the time, because it can gap below, but 1% loss of the total account, generally that's the max you're going to have, and it's not fun, but you can recover from that. It's really hard to recover from larger ones. So those are the weekly trades. Let's talk a little bit about trader psychology before we get into next week's potential trades. This is from Peter Robbins. Peter Robbins is one of the market wizards, and great channel on Twitter to follow at PR Robbins. And like I said, he's a market wizard. They did a whole section on him on the book. And, when he says something, I think we should listen. Let's see what Peter has to say. What works for one trader might be a weakness for another. Some buy breakouts, others short breakdowns. Some ride trends, others ride counter trends. Some chase value, others momentum. The secret? Discover what works for you and master it. And it's so true. Not all trading approaches work for every single trader because the trading approach you use needs to fit your personality type. You could give me like the best long-term trend following system. It would be impossible for me to follow it. Even if I knew it worked, it just doesn't fit my personality. And, scalping 1 or 2 minute positions intraday doesn't work for my personality either. And so, there are certain things that will trade better for you. And really what it comes down to, there are certain trading approaches that you feel comfortable with, that you will follow that plan. If you followed all the plans, you probably do just fine. But there's some plans that just doesn't gel with your personality. There was another market wizard, I can't remember who it was. I don't know if it was Ed Dakota, but he said, do more of what works. And it's a very simple sentence, but it really is important, because if you trade one particular way and it tends to work better for you than others, do more of that. Because for whatever reason, that particular strategy, that particular approach gels more with your personality. And really what's happening is you're just following that more precisely and more correctly than you are others. So, whether it's short-term, long-term, trend following, counter trend following, like Peter said, find the one that works for you and just do more of what works. So thank you, Peter Robbins. Appreciate that. Hope you guys found this helpful. And now let's head over to the potential setups and potential trades for next week. Okay. So these are the 10 symbols that I did identify for potential trade for next week. They're not, again, in the location where they need to be, but if they get there, then I will consider the trade. But that's the key. That's the discipline of waiting, of looking at a chart, identifying a level that makes sense to you. And then if it rejects that level, then considering taking the trade. But again, here are 10. I do want to point out, though, that theoretically all 10 of these could trigger on Monday. So does that mean I would take all 10 trades? No, I would narrow it down. Even if all 10s triggered, I would narrow it down to the best one. And so, how would I do that? Well, I would first of all look at how many signals, maybe one stock has one entry signal, but the second stock has two entry signals. Obviously, I would take that one. So, I give it a bit of a score. How many entry signals? The more, the better, the higher the score. The risk to reward ratio. I'm also going to take that into account. I'm going to look at higher time frames to see, let's just say the first three here, Alibaba, Berkshire, and uh, the gold miner index, let's say they all have three entry signals. So how do I define it? And they have the same risk to reward ratio. Well, then I would look to the higher time frame and go, oh, okay, there's one of those three that on the higher time frame just bounced off a major moving average on the higher time frame. So how many entry signals they have, the risk to reward ratios, how do they look on higher time frames, and then I also look at the relative strength of that particular market compared to the broader market. Let's say the broader market's down. However, this particular stock, one of these particular stocks, it's up on that day. Well, then that means that the relative strength of that stock is higher than the rest of the market. So that might be the tiebreaker. So these are all the things that I teach in my one-on-one course. Really, the devil's in the details here. So again, if you're interested, I would love to be able to speak with you, love to be able to teach you how I trade and teach you the one-on-one course. And really, the best way to learn anything is one-on-one with your instructor. So again, my email's in the link in the description. Just send me an email and we can start a discussion. So here is Alibaba. So I have been talking about Alibaba for a couple weeks here, and what I'm looking at is the 200-day moving average. Here's the black line. This is the level that I'm looking for a potential rejection. Again, this would be a deep dip buy. We did have an abandoned baby here. I didn't take the abandoned baby, and the abandoned baby so far worked, and then it's kind of come back. It's come right back to the top there and then bounced magically. But I didn't take it, but I'm waiting for a rejection here of this 200-day moving average. That's the level that I'm looking for. If it doesn't get there, it just moves up, then great. Great for everybody that has Alibaba. But if it does come back down, reject, bounce its 200-day moving average, or an intraday rejection of the 200-day moving average, or close under and then close back over, then that would be a legitimate deep dip buy. So that's what I'm looking for on Alibaba, a rejection of 82.26 at the 200-day moving average. Okay, let's go to Berkshire Hathaway. There's a strategy that I use, and I just, with this market going up like this, I haven't had a lot of opportunity to use this, but Berkshire Hathaway, BRKB, right now is set up for a potential return to value V1, V2. You can see the green line here, the green line here. This is called the value zone. I don't like to buy above the value zone. I like to buy in the value zone, sell above the value zone, or buy below the value zone, sell in the value zone. So the rules for a return to value V1, V2 is, first of all, you have to be above the value zone. You have to close above the value zone. This green line here, above the value zone. Well, the first requirement is you have to come back into the value zone, which we did on the 3rd of December. The second requirement is you have to stop going down. So we came into the value zone, but the next day we closed even lower. So it has not stopped going down. But now we have 2 days of sideways motion. So we were above the value zone, returned to the value zone, 2 days of sideways motion. Now this is set up perfectly for a return to value V1 or V2. All we need is the entry signal of a V1 or V2. So on Monday, for example, for a V1, we'd have to go below Friday's low and then close above Friday's close. That would be a return to value, sideways motion, V1 or a V2. So theoretically, we could have a V2 on Monday, because here is bar 1 on Thursday. Friday, we did go below the low. So I didn't notice this until right now. Let's see, the close here is 470.57. 470.57. So technically, if on Monday we close above 470.57, it's a valid return to value, sideways motion, and a V2. Because Friday did not close above Thursday's close, but if Monday we close above that, then that would be a legitimate return to value V2. And if that does happen, I'll place my emergency stop 2 ATRs below, and my end of bar stop will simply be here halfway Friday, which is the washout bar. Halfway of that is about 469.50. Oh, I'm glad I didn't notice this actually before when I was getting ready for the show. So yeah, so basically there's the trade. So I will consider getting long Berkshire Hathaway if it closes above 470.57. I'll position size correctly, place my 2 ATR emergency stop below, and then my stop would simply be a close below 469.50. See how close that is? That's what I love about return to value V1s, V2s. So if it closes above 470.57, then my stop would simply be a close below 469.50. So the risk to reward ratio on this particular stock is really good. So we'll have to see. If it closes above 470.57, I'll consider taking trade. If it gaps way up, I'm not going to take it because then my risk to reward is poor. Does that make sense? So that's what I'm looking for on Berkshire Hathaway. GDX, which is the gold miners, I'm just looking for a deep dip buy here. If it comes down, bounces at the 200-day moving average. You can see back here on the 14th, it's exactly what happened. That deep dip, I nailed it, didn't it? Got right to the 200 and bounce. Will it get there again? I don't know. If it does get there, will it reject it? I don't know. If it gets there and it might just go down through it. So I don't know. So we never know. None of us know. So if it comes down next week, bounces at the 200-day moving average, intraday rejects the 200-day moving average, which closes under, closes over, I will consider taking the trade. GLD, gold, well, you can see I have a bearish island reversal. See how we gapped up and then immediately followed by a gap down? Well, generally that is bearish, but I'm not going to short it all the way down here. The risk to reward ratio is not good and the move was too strong. So I'm looking for a move back up to the bottom of this abandoned baby, which is 247.80. If it just keeps going down, well, if it goes down enough near the 30 RSI, then I'll look to get long. But if we do rally up to the bottom and reject the bottom of this abandoned baby at 247.80, I consider getting short there. I'll place a 2 ATR stop above for an ATR profit target below. Intel. So Intel had a really tough week with some news, their CEO retiring or being ousted, however you want to say it. But look, I have the green box here. What does that mean? Well, that is a bullish order block. And I took this trade. Well, let's go back to the order block. The order block was back here on the 7th of October. Here's your lowest bar close before market structure change here. Then we came back into the order block. I remember I got long right here and rode that up there and then got out here. But now look, we're approaching this order block, and the high of the order block is 2025. The low is 1895. So that's what I'm looking for. If we come back lower, top of the order block there, 2025, if we bounce there, just like on the, what was it, the Etsy trade. This is identical to the Etsy trade. I don't know if it's going to work out that well. Be nice, but who knows. So first order business, I'm looking for a rejection of that order block at basically 2025. If it doesn't reject it and keeps going lower, then maybe if I get a V1 or a V2, that could get me long there. Or barring that, if we go all the way back down, test the bottom of this order block here at 1890 and then close back above, then that could also get me long as well. So, but basically between 2025 and 1890, this is the area that I'll be looking for. Look, we're at 3393 RSI right now. So we are getting pretty close to that 30 RSI. And I think if we did get to the top of that order block, then you may have that confluence of an under 30, over 30, and a rejection of the high of that order block at 20, about 20, 25. So going to be watching Intel closely. Coca-Cola, all right, well, Coca-Cola did bounce last time at the 300-day moving average back here on the 15th, and it bounced pretty strongly, but now we've come back, given back. But I'm looking at the 300-day moving average here for a deep dip buy. 300-day moving average is at 61.22. We're at 62.53. So that's what I'm looking for. I'm looking for a retest of that 300. It held nicely last time. Doesn't mean it's going to this time, but the chances are better. And I can already tell from a MACD perspective, look at the bearish MACD here, very bearish MACD, then we rally. If we come back down and test this low, you may have a little red MACD, but you're not going to have this depth of red MACD. So what does that mean? That means you'll have a double bottom bullish MACD divergence at a key level. So I am really going to watch this closely, and I am interested in getting long Coca-Cola at the 300-day moving average. Huge sell-off, huge. But I would expect, it looks to me like we are starting to run out of buyers. But who knows? I could be wrong. But first thing I need to see is a rejection of that 300-day moving average there at 61.22. Lockheed Martin. Well, wow. So Lockheed Martin, all it did was go up, 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 and now it's come straight back down. Defense contractor. Well, that 200-day moving average sticks out like a sore thumb. And if we go back to the 200 last time, did it respect it? Yeah, it sure did. Look here. Just a simple close above that 200-day moving average had a huge, huge move up. Doesn't mean it's going to respect it this time. No, it does not. But does it set up for a good structure of a trade? Yes, because if it rejects the 200-day moving average and then next day simply closes below, I am simply out. But so I'd be very quick to get out if it closes under the 200, but if it stays above the 200, we could have a pretty significant rally again like we did. So 200-day moving average is what I'm looking for, 501.13. Barring that, if it closes below and keeps going down lower, then you have the 250-day moving average, 487.03, or the 300-day moving average at 477.02. But first stop is the 200-day moving average. And in addition, look, we're at 31.59 RSI. So it actually on Friday, I believe we did go under the 30 RSI and close back above. So in a way, that was already a legitimate entry, but I'm waiting for the 200. And look at the MACD here as well. Look at this low. Look how deep the red MACD bars are. Then we rallied. Then we're much lower here than we are here. But look, the MACD bars are much more shallow here than over here. So this is already showing me that we are starting to run out of sellers. So the implication is that if you run out of sellers, you're going to go up. So the 200-day moving average, I would imagine, would bring some buyers in just by the fact you're the 200-day moving average. So I think we could definitely see a bounce in LMT. But again, I'm waiting for a rejection of the 200-day moving average. The Qs, QQQ. All right, well, this is just the general NASDAQ market here. What I want to point out on the Qs is something called three little Indians. That's when you have three symmetrical tops. Generally, that's kind of a short-term, at least a short-term top. You take the high here, you connect the high here, you put that out into time. Look, the NASDAQ has been so strong, but if we do run into this trend line here about 532.47, that might be a short-term top. Will I short that? I'm not sure. It's possible. It's possible. It's definitely possible. I'm just going to see what happens. But, I put this in for two reasons. One, to show you that if we do get there, yes, it's a potential short. If it closes back above the trend line, that would be my stop. I just get out. But two, as far as the market in general, I just wanted to show you that we are on the NASDAQ here getting up to the level where we have three symmetrical tops, three little Indians. And I mean, we're pretty high anyway. And look, we rejected the 70 RSI on Friday. We're at 69.99. It was higher. It was 70 RSI at one point, and then we closed under. So, yeah, I would potentially short that trend line. But again, the other reason I'm mentioning this here is just general market conditions is we may be getting pretty close to a top. And the same thing with SPY, although the SPY is a little bit more bearish because look here at the highs. Look how high the green MACD bars are. Now we are higher here than here, right? But look, the green MACD bars are not as high. So this is called the double top with the bearish divergence. And it's the same thing. We have these potential of 3 symmetrical tops. So I'm not saying that the SPY can't go higher. It very well might. But if it gets up here to this trend line, this channel, the 3 little Indians, in addition to this bearish MACD divergence, that could be the top for a while. So I'd be more likely to short the SPY because of the divergences, the bearish MACD divergences we have. So yeah, so if we go higher next week, reject that trend line, I would certainly potentially get short. And then XLV, this one's pretty simple. Just here's the 300-day moving average. We closed under, closed over, then we had a nice rally up, and then last week we pulled back. Wouldn't surprise me that we pulled back to the 300-day moving average, which is at 143.15. That would just set a good structure for the trade. Very easy. If it rejects the 300-day moving average, position size correctly, place the 2 ATR emergency stop below. If it closes below the 300, I'm just out. That's all there is to it. If it stays above, then I continue to phase out. If it moves my way, get to trailing stop level, all that kind of stuff. But I am looking for the 300-day moving averages for a potential bounce to get long. So those are the dailies, and then let's head over to the weeklies. Weekly bars close on Friday, so I would make my decision on Friday. Okay, 200-day moving average on the week. If we get down to it, it's at 60, what does that say? 66.76. Right now we're at 70.24. I would consider getting long oil USO next week if we come down and reject that 200-day moving average. Pretty simple. As long as it stays above, I'm in. If it closes below, I'm out. And then last but not least is VIX. So VIX, has just gotten monkey hammered, man. I mean, look, we had this huge move up in volatility and straight back down, but we are in a bullish order block. And look, I just went over on the Qs and the SPY how that's starting to look toppy. Well, the VIX is starting to look bottomy as well. Here in the green box is the order block. This was the lowest low close before market structure change. If you come back to the order block, that's where you tend to bounce. So we did get into the order block. We didn't reject it though. We stayed in it. Next week, if it closes back above, I may get long VIX there. 2 ATR emergency stop below. My end of bar stop would just simply be a close below $40, which is the low or the order block. If it keeps going down and rejects the 40 level and closes back above, then I could get long there as well. But the VIX, the VIX is very, very low, everyone. It's showing that there's absolutely no volatility, but that's also when there's no volatility at all. Volatility never goes away. It's at such low levels that it makes me think that we have a chance of bouncing on the VIX here. And if we bounce on the VIX, then the market very likely will be going down. And I just kind of made my point on the Qs and the SPY of the channels up there and the bearish divergences. So it would make sense. If we bounce here, I would not be surprised at all for the rest of the market to go down. So keep that in mind. So anyway, I hope those were helpful for you looking at the dailies and the weeklies, and appreciate you being here today. Like I said, if you learned something, if you found something of value, I'd appreciate if you could hit the thumbs up button. If you're interested in working with me and studying with me with my one-on-one course, love to have you as a student. I'll teach you everything I know. You're going to learn a skill that you can use the rest of your life. My email's in the link in the description. If you're interested in that deep dip buy course, it's super affordable. It's really great. I think I have 4.8 or 4.9 stars on Udemy, and that is also in the description. But always just want to leave you off with, please try to go out and do something nice for somebody today. The world would be a lot better place if we all did one nice thing every day for another human being. If you could also try to go and do one nice thing for an animal, that would be very helpful, and they appreciate acts of kindness just like we do. So if you have any comments or questions, please let me know. Just put them in the comment section. I'll do my best to get back to you. I hope you enjoy the rest of your weekend, and have a good trading week next week. But please follow your rules. And like I said, just my opinion, I could be wrong, but there's a lot of kind of red flags here at the top. So we, in my opinion, I think we're getting close, but I could be wrong. But always keep it in mind as a possibility. So thanks again, everyone. Appreciate being here. And God willing, I will see you next week. Take care. Thanks a lot. Bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.